It just got worse for variable rate mortgage holders with fixed payments. And that means pretty much anybody who has a variable rate mortgage at a big bank that isn't Scotiabank. And the reason why is because the banking regulator just suggested that 70-year amortizations aren't going to be something that exists in the future. In other words, saying that the banks are going to have a responsibility to make sure that upon renewal, mortgages that have been taken out and are renewing will be either returned to their previous contract terms, so in other words, re-amortized back to what they should be, or will be considered for a refinance to a longer amortization. But that being said, amortizations in Canada typically don't go past 30 to 35 years, which means anybody who's in a situation where their amortization is extending out to 70 or 90 years, or anything over 35 years for that matter, may be subject to renewing into significantly higher payments at, well, a significantly higher interest rate. In this video, I'm going to discuss exactly what's going on, and I'm also going to make some suggestions for what you should do if you find yourself in a situation where you have a variable rate mortgage with a fixed payment and an amortization that is not moving in your favor. So in other words, is getting longer rather than shorter. But before we get into it, my name is Nolan Matthias, and if you want the latest Canadian real estate and mortgage news, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. And by the way, if you're new here, or if you're wondering why when you look at that little subscribe button, you aren't already subscribed, it's because this is a new channel dedicated to Canadian real estate news. The other channel, my big channel, still exists. So if you aren't subscribed to that one, go and subscribe to that one as well. But this one is primarily Canada focused. And if you haven't already subscribed to this one, but you're subscribed to the other one, well, you got to hit the subscribe button on this one as well. I mean, if you want Canadian real estate news, that is. Oh, and one last thing. If you still want to get my book, Mortgage Secrets, and if you're watching this video, you're probably going to need it. And by the way, as we get further into this dilemma and to this problem that we're facing right now, I am going to update that book with new chapters, and I am going to send them out to anybody who has bought the book already, totally free of charge. So as we get into these variable with fixed payment renegotiations with lenders, you're going to have up-to-date information. So you can get that book absolutely for free and all the updates in the future absolutely for free by going to mortgagesecrets.ca and simply paying the shipping and handling. And by the way, our shipping company, a little bit slow right now. So if you buy, and anybody who has bought previously, I'm also going to send you out a digital copy of the book to make up for the shipping delays. Okay, so let's get into what's going on with the banking regulator, the Office of the Superintendent of Financial Institutions. This is the organization tasked with regulating banks. And they have come out this week or last week and made it very clear that they do not expect 70-year amortizations to be something that is going to go forward. So in other words, what they're saying is that anybody who has 70-year amortizations because they had a variable rate mortgage with a fixed payment, interest rates have gone up, payments haven't increased, and therefore it is negative amortizing, those mortgages will be expected to be returned to the original amortization. So in other words, if you got a 25-year mortgage 5 years ago and you were supposed to have 5 years of it paid off, they're going to expect the bank to renew you at 20 years or do what's considered a refinance. So in other words, refinance you into a longer term. Now, we don't know what the exact details of this are going to look like, but where that could become problematic is if, when you're refinancing into a longer term, you are required to requalify. Because if you're required to requalify because it's a refinance and you no longer qualify for that original mortgage or the mortgage that you have with the shorter 30-year or 35-year amortization at the higher interest rate, well, you could be asked to either make a lump sum payment in order to bring your mortgage back up to where it should be from a contract perspective, the original contract perspective, or you may be asked to pay the mortgage off entirely. And if you don't qualify at other lenders, that could cause you to find yourself in a situation where you are forced to sell or where you find yourself in default. So this is really important to pay attention to. Now, variable rate mortgages with fixed payments, luckily, there are 0 clients in my book of business, at least that I'm aware of. There may be 1 or 2 that somehow slipped under the radar and ended up with a TD mortgage because they requested it. But pretty much anybody who has a mortgage or got a mortgage with Mortgage 360 has the proper type of variable, at least in my opinion, which is a variable rate mortgage with an adjustable payments, and they felt their payments adjust as interest rates have gone up. So they're safe. But if you have one of those ones where your payment hasn't changed, you need to pay attention to what's going on here. And if we look at the numbers from RBC, it gets really, really interesting here because what they're saying is that 43% of its Canadian residential mortgages had an amortization period longer than 25 years. So that means that 43% of their mortgages at least are in variable rate mortgages with fixed payments. So if 43% of their book is definitely in that type of mortgage, and 43% of TDs and 43% of CIBCs and 43% of BMOs are definitely in that category, well, there's a lot of people that have this type of mortgage that need to be focusing right now on making changes or preparing for what's about to happen when their mortgage comes up for renewal. And there's a bunch of things you can do here, but they all involve reaching out to your bank and asking them what your options are going to be going forward. Now, if you've got a renewal 2 or 3 years down the road, they may not be able to provide you answers of what that's going to look like 2 or 3 years down the road. But there are some things you can do right now to make sure that you don't find yourself in a really bad situation when that mortgage comes up for renewal. The first thing I would look at is I would look at locking in your rate to a fixed rate mortgage at your original amortization. Now, yes, this is probably going to mean that your payment is going to go up substantially. It's probably going to mean things are going to be a little bit painful for a while financially, but it is also going to mean that you aren't going to have a significantly worse problem down the road, assuming that interest rates stay the same or if they go up. Now, there is this chance that interest rates could come down and you could be okay, but you really need to assess whether or not financially you can handle the burden of if interest rates don't come back down. And you need to be honest with yourself. If companies start doing layoffs, are you going to be one of the first ones to be axed? Do you have significant amounts of cash in reserve if you need it? Are you going to find yourself in a bad situation if the worst case scenario happens? And if you aren't absolutely 100% certain that you're going to be able to survive any financial hiccups that come along with that variable rate fixed mortgage payment, well, you need to take action right now. Don't delay this. Don't wait until it is too late. You can take action now and find yourself in a significantly better position than had you waited. Now, the other thing that you can do is if you have cash reserves set aside, you always have the option to make lump sum payments to bring your amortization back in line with what it should be. Now, most people aren't going to have that option. So likely one of the best options, if you feel like maybe interest rates are going to come down and you want to kind of take the chance and gamble a little bit on them coming down, would be to simply go to your bank and say to them, right now, if I kept my variable rate mortgage, what do I have to increase my payment to in order to get my amortization back to where it should be? And then if interest rates do go down, well, at that point, you can go back to your bank and ask them, they might not do this, to lower your payments once again. But you need to, if you have that fixed payment, increase your payment, make a lump sum, or get that thing locked into a fixed rate mortgage. Because if you don't and interest rates don't come down, well, OSFI is very clearly stating that you're going to probably find yourself in a situation where you're going to be forced to make those changes. And the longer you delay, every single day that you push this back, the impact to your payments and the impact to your financial situation are going to get worse and worse and worse. And by the way, there's one worst case scenario here, and that is where the banks start deselecting clients. A couple of them have already started talking about doing this, and we've seen banks already start to deselect some clients. And that could mean that you're going to be told, hey, we don't want your mortgage anymore. Go find something somewhere else. And if you can't do that, you're going to be in trouble. Oh, and by the way, if you want to see the video where I talk about exactly that issue, make sure you check it out right here.